Today, we're diving into the financial world's most spectacular disasters, where the genius tool of options became a weapon of mass destruction, bankrupting Nobel laureates, costing a mega bank billions, and making fortunes vanish in minutes. Imagine this, a hedge fund so brilliant it was considered infallible, losing $4.6 billion in 4 months. A simple hedging strategy that spiraled into a $6.2 billion loss known as the London whale, and an event so sudden it was nicknamed Volmageddon, wiping out investors in a single afternoon. These aren't just stories, they're masterclasses in how leverage, complexity, and greed can create market chaos beyond your wildest imagination. Let's dive in. Our first battle takes us to the 1990s and a hedge fund called Long-Term Capital Management, or LTCM. This wasn't just any fund, it was run by Wall Street's dream team, including 2 Nobel Prize-winning economists. They thought they had cracked the code of the market. Their main strategy? Selling options. They sold billions of dollars worth of options on stocks, bonds, and currencies, collecting the premiums. They were essentially selling insurance, betting that the market would stay calm and predictable, just as their genius models predicted. But here's where it gets insane. To juice their returns, they used massive leverage. For every $1 of their own money, they had borrowed over $25. Their total exposure was over $1 trillion. Then came August 1998. Russia defaulted on its debt. It was a black swan event their models said was nearly impossible. Global markets panicked, volatility went nuclear, and all of LTCM's safe bets blew up at once. They were losing hundreds of millions of dollars per day. The fund was so big and so connected that its collapse threatened to take down the entire global financial system. The US Federal Reserve had to step in and orchestrate a $3.6 billion bailout from other Wall Street banks just to prevent a total meltdown. The dream team was humbled, proving that in the world of options, even geniuses can go broke. Now let me explain how selling options can get so dangerous with my insurance company analogy that'll blow your mind. Imagine you start an insurance company that only sells fire insurance for one specific neighborhood. You sell 1,000 policies and collect the premiums. Easy money, right? That premium you collect is like theta in options trading, a steady income from the passage of time. But what if one house catches fire? That's your delta risk, the immediate payout you owe. Now what if that fire starts spreading to the next house and the next, and the wind is picking up? Suddenly, your risk isn't just one house, it's the whole neighborhood. The rate at which your risk is accelerating is gamma. A gamma squeeze is when that fire spreads so fast you can't contain it. And what if a news report comes out that an arsonist is loose in your neighborhood? The fear of fire skyrockets. That's your vega. The risk that implied volatility will explode, making all your policies insanely risky overnight. LTCM got burned by all 3 at once. Fast forward to February 5th, 2018, a day that will live in financial infamy as Volmageddon. For years, one of the most popular trades was to short volatility. Thousands of investors, from hedge funds to retail traders, piled into products like Gansenti, which was basically a bet that the market would stay calm forever. It was like picking up pennies in front of a steamroller. You made a little bit of money every single day until you didn't. On that Monday afternoon, for reasons still debated, the market had a sudden hiccup. The Dow Jones dropped and the VIX, the fear index, woke up. And it didn't just wake up, it went absolutely berserk. The VIX spiked over 115% in a single day, the biggest one-day jump in its history. Those inverse volatility products, which were designed to go up when the VIX went down, did the opposite. They collapsed. 14, which had been trading at over $100, lost 96% of its value after the market closed. Billions of dollars in investor capital vanished in a matter of hours. The house didn't just change the rules, it burned the entire casino to the ground. Our final story shows what happens when a simple hedge becomes a catastrophic speculative bet. In 2012, a trader for JP Morgan Chase in London named Bruno Ixil was tasked with hedging the bank's credit risk. To do this, he used credit default swaps, CDS, which are basically put options on a company's debt. But his position became so enormous that he himself started to move the market. Other traders nicknamed him the London whale because his trades were making massive waves. Hedge funds smelled blood. They realized the whale's position was too big to exit without causing chaos. So they did the unthinkable. They took the other side of his trade. They began buying the very CDS contracts he was selling, intentionally driving prices against him. It was a classic squeeze. The whale was trapped. Every move he made to try and reduce his position only made his losses worse. It became a death spiral. By the time the dust settled, his hedge had morphed into a $6.2 billion trading loss for JP Morgan, resulted in massive regulatory fines, and became a textbook example of how even the biggest players can get squeezed when their options positions become the target. Now, before you think options are just financial dynamite, let me drop some truth. These epic disasters are rare exceptions that make headlines because they are so extreme. The real options market is a massive, essential risk management system. Farmers use options to protect against falling crop prices. Companies use them to hedge against currency fluctuations, and everyday investors use them to generate income with covered calls or protect their stock portfolios with protective puts. It's about transferring risk from those who don't want it to those who are willing to take it. These legendary battles teach us that with great leverage comes great responsibility, that risk models can fail spectacularly, and that even a safe hedge can become a multi-billion-dollar disaster if you're not careful. If these financial war stories blew your mind, smash that like button, subscribe for more market madness, and let me know in the comments which disaster shocked you the most: the Nobel Prize-winning collapse, Volmageddon, or the London whale. Until next time, keep your leverage reasonable and always respect the power of gamma. Peace out.